Our second profit target is created in the exact same way. We would take our range, which is 86 cents, and add it to target number 1, which is $45.44. It's a little bit easier for me to take the target number 1 of 45.54 or 45.44 and just add the 86 cents to it to get target number 2, which is $46.30. To calculate our third profit target, all we have to do is add 86 cents to profit target number 2, and we come up with profit target number 3. In this particular example, we count the inside day as day 1, we count the very next day as day 2, the next day after that day 3, and day 4 the day after that. In this particular instance, we would have entered this position precisely at 44.58 when the stock began to trade above 1 penny above the prior day's high of our inside day. Our first target was hit on the very next day at 45.44. Now, generally, conservative traders will get out at that point, take a profit, and move on to the next position. If you're a slightly more aggressive player, you might want to take half of your position at target 1 and then move your stop loss up to break even at your entry point of 44.58. That way at least you have a profit on half of your shares, and then the remaining shares you would have a break even point of 44.58. And then if in fact the stock continued to trade higher and hit target number 2 as it did in this example, you would then sell out another 50% of your shares at $46.30. In this particular case, if we had 1,000 shares that entered at 44.58, we would sell immediately half of those shares, or 500 shares, at 45.44, move our stop loss up to 44.58, our entry price on the remaining shares, and then as the stock continued to trade and hit our target number 2, we would settle out 250 of the remaining 500 shares, another 50% of our position, our existing position, at 46.30, leaving us with 250 shares yet. This particular example did not hit our target number 3 of 47.16, but as we get into the days, we have 1 day, 2 day, 3 day, 4 days. We have a fourth day rule, which states that you are either to exit the position at the close on the third day or the open of the fourth day, whichever you fit your comfort and trading style the best, because this trade is really meant to work very, very quickly. In other words, after the fourth day, if you're not hitting your profit targets or any of your profit targets, and that could happen. I mean, this could, the particular type of strategy that we're using generally will have an explosive move like this one. But sometimes it'll just kind of hang around down here and won't really make any progress at all. If that's the case on the fourth day, whether or not we hit our profit targets or not, you will want to exit this trade. Because if it's not working out after the fourth day, then you want to exit it. This trade is meant to work very quickly, and if it doesn't, that means there's something wrong and you really want to get out of the position. Now, aggressive traders may, after the fourth day, if none of the profit targets are hit, you may want to exit the majority of your position, but keep a little bit just in case the move starts a little bit late. Now, the one thing I should mention right away is once you do enter the position, you want to set a stop loss limit at the opposite end of your inside day. In other words, if let's say you set up an entry at the 44.58 to go long on the position, and you had an entry of 43.4370 cents in order to go short on the position. Once one side of your entry is filled, if your 44.58 long position is entered and filled, then you want to change this short order entry to a stop limit, and that will be your stop loss limit right here at 43.70 as you begin this trade. Now, once you see the position actually starting to hit your profit targets, you might want to raise this stop limit now up to maybe even 50%, or this 25% top line, or maybe even your break-even point. In other words, once your position hits your profit target number one, you may want to just lift this stop loss up along with the price trend and kind of follow along with it, so that at least if you hit your profit target, then that is, if you don't exit 100% of your position, then you want to make sure that you raise your stop loss along with your profit targets, so that you don't, if there is a quick reversal, you'll be able to get out and still maintain your profitability in the position. Let's talk about trade management for a second. The benefit of the trade setup is that it's really mechanical. You have precise entry points for your long position, you have precise entry points for your short position, so you really don't have a lot of choices in the trade when it comes to entering the position. You're going slightly above the high of this inside bar and slightly below the low of the inside bar. Now, in some cases, as I mentioned, aggressive traders can take positions, and let's just zoom in here. Within these 25% channel lines, aggressive players may actually want to enter a little bit early in anticipation of a breakout to one direction or the other. But that's for aggressive traders only. In most cases, you're probably better off waiting for your entry price, which is 1 cent higher than the high and 1 cent lower than the low of our inside day. In some circumstances, there's actually a fake out. In other words, it breaks through the high of the inside day, but then immediately reverses and goes lower. And I'll show you an example of that very soon. If that should happen, there's actually an opportunity to reverse your position, and even though you've gotten stopped out and the position continues to go lower, you may have an opportunity to stop and reverse your position and go short once it hits the lower end of your entry and your short entry position. But that's really a rule for aggressive traders. I'll show you an example of that, and it's really quite interesting, because, and the reason why that actually works out very, very well is if the fake out comes up to the upside, and all of a sudden the bar reverses, the day reverses and goes much lower to the downside, there's a kind of a piling on effect, so that people know that if it broke through, people were buying the stock in anticipation of a breakout, and all of a sudden the bears came in and started selling like crazy. There's a piling on effect of people who had purchased the stock here now have to sell the position, and they're selling it at a much lower price, continuing to fuel the selling pressure on the stock, driving the stock even lower. Here's an example in Chesapeake Energy of exactly what a fake out looks like. You have an inside bar, which is a relatively narrow inside bar, at least 50% or less of the bar that precedes it. This particular inside day, if you were to trade this, you would have entered a short position at 49.02.